Hey, this is Justin from BreakIntoCRE.com, and in today's video, we're going to talk about the effect of debt on commercial real estate returns. So if you're considering adding debt to a commercial real estate acquisition or refinancing a property, and you want to know the debt levels that make the most sense for your deal, make sure to stick around for this video. Now, if you're new here, on this channel, we talk about real estate investing careers and real estate financial analysis. So if you're looking to break into the industry or advance your current real estate investing career, make sure to subscribe and hit the notification bell. Now, most commercial real estate properties aren't purchased with all cash, and most properties have some sort of debt on that property when they are first acquired. And leverage ranges can vary all across the board, but generally what you'll see is somewhere between 50% and 80% of the overall value of the property as the total loan proceeds on a commercial real estate deal. So what happens to returns when you change your levels of leverage from the lower end of the spectrum at 50% all the way up to the higher end of the spectrum, or 80%? Specifically, what happens to your main investment return metrics like your internal rate of return, or IRR, your equity multiple, and your cash on cash return? Well, the way that we're going to look at this is with a sample 10-year cash flow statement. And what this cash flow statement is doing is it's modeling out cash flows for a 10-year sample analysis. So in this case, if we look at this sample analysis, we can see that if we have 50% leverage on this specific deal based on these inputs, our internal rate of return, or IRR, is 10.7%. But now if we increase this from 50% to 80%, we'll find that our internal rate of return jumps all the way from 10.05% up to 15.82% for that same 10-year analysis. So obviously this is a huge difference. So what is the difference, and why does this change so dramatically? Well, the biggest reason why this jumps so quickly is because of the net sale proceeds as a multiplication of that initial equity investment. So in the 50% leverage case, the net cash flow after sale, including the loan payoff and other costs of sale, is 1.61 times the initial $2.978 million equity investment, which is not bad at all. But if we take a look at the 80% LTV scenario, what we see is the net cash flow from the sale after the loan payoff and cost of sale is 2.68 times greater than the initial $1.271 million equity investment, creating a much greater return on that initial equity contribution. Now, speaking of the multiplication of that equity investment, let's move on to the next return metric, which is going to be the equity multiple. So the equity multiple is just going to be a multiplication of your equity invested in the deal. So if an equity investor invests $100,000 into a real estate deal, and over that entire 10-year hold period, they receive $200,000 in cash back, that equity multiple is going to be 2.0. So if we set that loan to value ratio back to 50%, we can see that that equity multiple for this deal is 2.34x. This means that the investor earned back 2.34 times their equity investment in the deal over this entire 10-year hold period. But if we bump that loan to value up to 80% and check the equity multiple again, what we see is that now that equity multiple goes up to 3.58x, which is significantly higher than that 50% leverage scenario. And to see why this is the case, the easiest way to do this is with a simple profit calculation. So for the 50% leverage scenario, the equity investor invested $2,978,750 upon acquisition and earned $6,981,201 on the deal over the entire 10-year hold period. But for the 80% leverage scenario, the investor contributed $1,271,000 on the deal and earned back $4,550,820. So even though the overall dollar earnings were higher at that 50% loan to value ratio, that scenario also required more than double the initial equity investment, which resulted in a smaller multiplication of that initial equity investment in that 50% LTV scenario. So finally, last but not least, let's take a look at how this is going to change the cash on cash return in this deal. So if we set our LTV back to 50%, what we can see is that our cash on cash return is 7.36% on average throughout the entire 10-year investment. And if we bump that up to 80%, what we can see is that now that cash on cash return jumps over 150 basis points up to 9.0%. So as you can see, in most cases for profitable deals, adding additional leverage is going to increase your overall returns for these three main metrics. Now, with that said, it's important to note that leverage is going to magnify your real estate investment returns, meaning that leverage can increase returns on profitable deals, but it's also generally going to increase your losses on deals that are not profitable. Additionally, increased leverage is also going to increase your overall probability and risk of default on a loan, increasing your overall loan payments on a monthly basis, and increasing your overall net operating income and cash flow before debt service requirements in order to pay your debt service every month. So aside from just the raw numbers in a best case or base case scenario, it's important to run the analysis on what happens to returns if occupancy drops, if rents drop, or both, in order to figure out what your comfort level is with your overall level of leverage on the deal. So I hope that was helpful if you're trying to figure out how much debt you should put on a property or if you should put debt on a property at all. Now, if you want to download the model that we used in this video, you can download that directly through the Break Into CRE Real Estate Financial Modeling Crash Course, and I'll link that in the description below. And that's going to walk through how a real estate financial model is built and the foundations of what you need to know to analyze real estate deals. So if you like this video and want to see more content like this, make sure to let me know by hitting the like button, subscribe to the channel, and share this with anyone else who might find this helpful. Thanks so much for watching, and I'll see you in the next video.